Hello. This is the first joint hearing of the House Ways and Means and Senate Finance Committee of the 2026 session. I think we're going to start off with a real fun one, talking about the impacts of the federal action this summer on both our revenues and the tax code. This is going to be a huge portion of what the House Ways and Means Committee is doing before crossover, and knowing that Senate Finance often doesn't have very much time after crossover to dig deep into something, wanted to make sure that we could all start off the conversation together. I know a number of years ago, when the Tax Cuts and Jobs Act passed, the legislature spent a great deal of time really separating our personal income tax code from the federal code. And I think one question we're going to be asking ourselves is, do we need to do the same thing with our corporate code this year? But that's just sort of one of the many questions that get opened up by this question about reduced revenues and complex corporate taxes. So I think we can start off with our first witness, unless would you like to say anything, Senator Cummings?
No, I think you've said it all.
Great.
This is the first weeks, and we are doing basic information to find out what the federal changes since we left, the impact that they're going to have on us, and start developing solutions if necessary.
Kirby, would you like to join us? Happy New Year.
Happy New Year. Happy new session.
And for anyone watching on YouTube, we know the cameras are a little funny right now. I think everyone knows what Kirby looks like, who's ever watched us before, and we'll be mostly sharing screen the whole time anyway, so apologies for the IT problems.
So Kirby Keaton, Legislative Counsel. I'm going to share a presentation with you.
I'm sorry, can I say one more thing? Mm-hmm. This stuff is like so deep in the weeds so quick. I don't think there's any expectation that anyone around this table is going to understand it the first time or the second time around. So we'll go through sort of deeper on different versions of it as we go along. So I'm going to try not to panic.
I'm going to teach you so well, you're going to get it. Before Pat's going to come up and say the same stuff in a different way, but you'll already get it before Pat. Even.
I love that. We'll just quiz Pat. Representative Odie, you have a question right out of the gate.
Already. So this is one big beautiful bill.
Yes, we will not be calling it that. In a lot of my written materials over the summer, we were calling it the Reconciliation Act. I think it's probably the most accurate to call it HR 1, so I'll probably be calling it HR 1.
Sometimes called B3.
We can just say the federal changes and we'll know, right? Okay. So this is what I'm going to go over with you. First, we're going to go through some of the changes from HR 1 that do not flow through to Vermont, but things you've probably heard about in the news. So I thought it would be worth touching on them just to show why they're not things that we have to deal with directly, because they're not flowing through to Vermont. And then we're going to talk about there's one personal income tax change that does flow through, and we'll talk about that. Then we'll talk about the corporate and business tax changes that flow through. There are about 9 or 10 of those. And then I'll talk at the end just briefly about decoupling and some of the nuances that come with if you do want to make any changes from the stuff that flows through, and like what that might mean for our planning. So first off, first day of session, first day of school. Should we do a pop quiz where someone tells me what the difference between an above the line and below the line deduction is? Or that could just be rhetorical, and I can tell you.
I think maybe you could just tell us.
Yeah, okay. I thought you would say that.
Yeah.
The reason I'm asking that question is when it comes to HR 1 that had over 100 tax and finance sections to it, big question that comes up when it comes to Vermont and what flows through is if it's an above the line deduction, then that means it gets baked into adjusted gross income, which is our starting place. So we care about all of it, of course, but we care about above the line deductions because those things flow through when it comes to personal income tax. But if they're below the line, that is, if they get taken out of if they get taken out of AGI after AGI is computed, then those things are not going to flow through. So right now on the screen here, we have the federal definition for taxable income, and you'll see the highlighted parts are some of the things you may have seen in the news, which are below the line deductions. They're being taken out of AGI. So these are things that are not flowing through to Vermont. So you'll see qualified tips is something that's new. Qualified overtime compensation is something that's new, and qualified passenger vehicle loan interest is those are all new federal deductions that do not flow through to Vermont because they are taken out of AGI, and we start with AGI. Got that? And this is just a reminder of where Vermont does start. We define taxable income starting with federal AGI, and then we go from there. So I'm going to touch briefly on some of these things that do not flow through. The first there, I'm not going to read this list, but we'll just touch briefly on them. First is the personal exemption for individuals age 65 and older. This is a new personal exemption at the federal level. It's a deduction of up to $6,000 for individuals age 65 and older, and then it phases out at AGI of $75,000 for individuals and $150,000 for joint filers. This is a temporary thing for tax years 25 through 28. If you've heard the president refer to or say something to the effect of, we're not taxing Social Security, this is what that's referencing. It's not directly having to do with Social Security, but it's for a demographic that's pretty similar to people who are living on Social Security income. And it's a deduction roughly equal to what they would owe on that. This is not a Vermont thing, though. As a side note here, this same section of HR 1 makes permanent the elimination of the personal exemption tax deduction at the federal level. So that's something that hasn't existed the last few years, and it will continue to not exist because of this.
Can I clarify, Kirby? When you say something doesn't flow through, it doesn't affect someone's Vermont's tax responsibility, but it still has a big impact on Vermonters, right?
Correct.
Okay.
Everything that we're talking about here, when I say it doesn't flow through, Vermonters are still affecting Vermonters on their federal income tax return. It's just not going to be part of their Vermont income tax return, and it's not going to be a part of the revenue generation for Vermont either. But yes, of course, anything on federal income tax is going to affect Vermonters. So the second thing you've probably heard a lot about is the taxation of tip income. So there's a new federal deduction of up to $25,000 for qualified tip income. It's available for occupations that customarily and regularly receive tips. Recently, the Treasury Department put out a list of these occupations, and they're probably what you would expect: food service, some entertainment, a lot of gambling professions I didn't know. And I learned that you're supposed to tip a locksmith, I guess, because that's on the list. I don't know. A locksmith. That's one of the occupations that would qualify here. So this does not flow through to Vermont. There's a phase out for this federal deduction for taxpayers with modified adjusted gross income exceeding $150,000 for individuals and $300,000 for joint filers. And this is another temporary change.
Can I ask a question?
Yes, I'm so sorry.
No problem. So just to clarify the flowing through to Vermont.
Mm-hmm.
So if it's affecting somebody's AGI, I mean,
Mm-hmm.
the distinction you're making is whether or not
Whether it ends up on the Vermont income tax return.
Right.
When I'm talking about flowing through, I'm talking specifically about the Vermont income tax return.
okay, but if somebody's AGI is impacted and we're starting with the AGI, maybe it's technically not flowing through to Vermont, but it's impacting what the tax liability is for somebody because we start with the AGI.
If it's affecting their AGI, I would say that it flows through.
Then it is.
Yeah.
Okay, that's what I didn't I thought you
So-
said the opposite. Okay, sorry.
Yeah, and sorry if I wasn't clear,
No,
but
no.
going back to this definition, you see that the qualified tips, subdivision 5 there, the deduction for the qualified tips gets taken out of AGI.
Okay, so the
it's-
things in the yellow are flowing through. to
Are
Vermont.
not.
Are not flowing through. Okay, this is where I'm confused.
Yeah.
Because if it's taken out, it's impacting their AGI.
No, AGI is calculated, and then these things come
Oh,
out.
I see. Okay, I'm sorry.
Yep.
Okay, got it.
That's okay.
Order of operation.
It's okay, yeah.
That's why we're here. It's great.
Yeah.
Thank you.
Yeah, and also you're teaching me to be more clear, so thank you. Where were we? Qualified overtime compensation, similar to tips, there's a new federal deduction up to $12,500 for individuals on qualified overtime compensation. This deduction applies to the overtime premium when a person's paid overtime. Let's say they get paid time and a half. This deduction goes towards the half, not your usual rate of pay, but the extra half. That can be deducted up to $12,500 for an individual. And it's temporary as well. There's a new deduction for interest on passenger vehicle loans. It's a deduction of up to $10,000 for interest paid on qualified passenger vehicle loans. There's requirements that the vehicle has to be made in the U.S. So similar stuff. You may have heard of that one. And there's also a new charitable contribution deduction for non-itemizers at the federal level. So this would be being able to take up to a deduction of $1,000 for a single filer without having to itemize. So this is a new thing at the federal level. And so that's it for the things that don't flow through. From here on, we don't have to make that distinction anymore. I'm going to talk about things that are going to affect the Vermont tax return. And for personal,
Madam Chair, may I
Yeah.
ask a question? So getting back to this charitable deduction, so you give $1,000 to the Alzheimer's Association, let's say. That's a charity, so that, but now in Vermont, we are not able to deduct that on our tax return. Does this allow us to deduct it or does not allow it?
this is a new option at the federal level for you to get a deduction for charitable contributions up to $1,000 for individuals, $2,000 for married filers, without having to itemize. Usually to take a charitable deduction at the federal level, you would have to itemize. But this allows you to take at least some charitable deduction without itemizing at the federal level. Does not affect anything to do with Vermont tax return. Just your federal one.
Actually, on the federal return, but not the state return. Okay.
Yep.
And the maximum is 2,000?
For joint filers, yes.
For what?
Joint filers, married filing jointly.
Yes.
Yeah.
Okay, thank you.
And what I want to offer the Ways and Means Committee is that as we're sort of thinking about decision points for ourselves and as other bills come to our committee with other tax expenditures or exemptions, that to some degree it's helpful to think about if the federal government is doing this, is it helpful for the state to sort of match up and build on that? Is it helpful to just say the feds are doing it at a scale we shouldn't bother? But it's another way of thinking about sort of how the things don't flow through are still impacting Vermonters and how we can think about that.
And as I remember, when we rewrote the personal income tax code, this charitable deduction was the focus of most of the concerns, so much so that we missed a medical deduction. And I remember being told, but the federal deduction still stays, so you can still donate $1 million at the federal level and deduct that. You have to itemize it. This just says, well, if you're a small donor and you give $10 to 20 different charities, you don't have to itemize that. You can just say, I
Yeah.
did it to up to a $2,000 charitable donation.
Yeah, that's correct. And I would add that the Tax Cuts and Jobs Act increased the standard deduction at the federal level so that fewer and fewer people are itemizing now. And that probably has something to do with the perceived need for allowing the charitable deduction
Right.
because most people are just not itemizing anymore. Okay. Moving on, the personal income tax, things that do flow through to Vermont. Vermont has its version of the Child Independent Care Credit. It is equal to 72% of the federal credit, which means changes to the federal credit are going to flow through to Vermont. There's a lot of number changes, but I'm going to try to phrase this in a way, knock on wood, it's easy to follow. Yes?
Dumb question. When you say expands the phase down, do you mean, which way are you expanding? What does that mean?
I'm about to say it.
Okay.
Sorry,
Okay.
I thought you were going on.
No. And I use phase down on purpose because at the federal level, it does not phase out. It just phases down to a certain point and then stops there. But at no point do you have too much money. You can always claim this. So that's why it says phase down. But here's how it works right now, and then I'll tell you how it's changing. For child independent care credit, most people will take this for child care expenses. So I'm going to use that as an example, paying for preschool. Right now, under current law, you can take between 35 and 20% of your actual expenses for preschool as a credit for this, okay? The percentage that you take depends on your AGI. It starts, I think, at 15,000 of AGI, where you could take 35% of your expenses, and then it phases down to 20% at 43,000 of AGI, which is a pretty low amount of AGI. So most people will be taking, most taxpayers will be taking 20% of their expenses for childcare as this credit at the federal level under current law. That's current law. Phases down to 20%. Most people can get a credit for 20% of their expenses. This changes, instead of it starting at 35% of your expenses, it starts at 50. And it's still at 15,000 AGI, where it's at 50% of your expenses. But it's changed so that AGIs between 43,000 and 75,000 can now have a 35% credit instead of, under current law, it would be 20% of your expenses. It's now 35. So that's why we say it's an expansion of that credit, because more people will be able to take more of their expenses as a credit. And then it continues to phase down between 86 and 104, or 86 for an individual, 150 for a joint return. It phases down, the 35% rate phases down through that. And then by the time you're between, by the time as an individual you're at 105,000 in AGI, that's when it hits 20% for you. So when you're at that level of AGI, it's going to be the same as current law, 20%. You're going to have phased all the way down. But for an individual making having less than 105 AGI, they're going to see an expanded credit. They're going to be able to take on, to claim more of their expenses as a credit.
Could you help me understand how this interacts with the CPAP program and the child care subsidies in Vermont? How are those factored in with your figured income, or do you?
What program?
The CPAP, the federal child care subsidies.
I'm not familiar enough with it.
They're not figured in.
They're not factored in. So if you are covered for childcare, you would only count for what you'd have to pay on top. So Vermonters may not get the benefit of this credit, is what we're hearing.
It's what you pay.
It's your expenses. So yeah, so if childcare is being provided for free for you, then you wouldn't have expenses.
So we are effectively, okay, that's interesting.
Do you have a question, Representative Bodie?
Oh, yes, that leads me to the follow-up question.
Yes.
Do we change and not give out the CFAP the way we have it.
So this is our first touch on all of this. Let us not be quite so far yet, but I appreciate the thinking. And we're going to go deeper into each of these pieces multiple times.
And so Pat has a chart for you showing
Yes.
the slope of those numbers I was trying to describe. Hopefully that will help. So, as I said before, Vermont allows 72% of the federal credit. So, the fact that this credit could be more for more taxpayers, that will flow through to Vermont and cost more. That's it for personal income tax. It gets a lot more fun from here because we're gonna go into business and corporate stuff. So a couple of, we broke this out as business tax and corporate tax because these first couple of things I'm going to talk about are, they're oriented towards businesses, but they do have a connection with the personal income tax return because of the way things flow through. First change is, there's a change at the federal level for residential construction. It's an accounting change. Under current law, in some limited situations for small construction projects, the business doing the construction has the choice of essentially waiting until the project is done before they claim the income. This is expanding that to be allowable, that type of accounting to be allowable for a much larger set of projects for residential construction. So this means that it's a matter of when taxes due, and it means that there'll be potentially more taxpayers waiting until a project is done before they start paying tax on the income from that project. Next thing, that's kind of business tax. So there's something called qualified small business stock that's allowable, or that's established under federal law. A person who owns qualified small business stock can get a lot of tax benefits for purchasing and holding the stock when they go to sell it.
Can you explain what one of those stocks is before you?
Yes.
Thanks.
Well, first we have to start with a qualified small business, which under this change means if you have 75 million in assets or less, you could be a qualified small business. And you would have the option of issuing stock called qualified small business stock. And these federal laws exist to entice investors for you. Because under this change, if you hold this stock for 5 years before selling it, you can not pay tax on that gain when you go to sell it. And the upper limits for how much you can have not taxed under this change is going all the way up to 15 million per issuer. That is per company that you've invested in, up to 15 million of gains that you could just exclude from your income and not pay tax on. So it's pretty enticing program, and it's being expanded, and this does flow through to Vermont. When this happens and this income is excluded at the federal level, it will pass through to Vermont. It will be excluded in Vermont. We'll be going through a lot of individual changes, like I mentioned. For some of these changes, they have a Vermont impact right away, and I'll point that out. This is one where the Vermont impact, the revenue impact, is going to actually be out. Because to get that full 100% exclusion, this has to be held for 5 years. And the way it was written is it has to be qualified small business stock that's purchased after 2025. So the impact is not going to be immediate. I'm not personally aware of how active Vermont is as far as having investors who buy qualified small business stock. So at this point, I don't know what it will look like. I'll just know that whatever impact there is will be 5 years from now and after that, and that this is a very big tax benefit. But as far as the universe of people out there, I don't know.
Madam Chair? So just gaming this out, the length of the years, it follows the stock from point of purchase, right? So you buy one tomorrow, you hold it for 5 years, and then I buy it from you, that clock resets.
That's a good question. I would want to double check about as far as the I know that when it gets issued by the small business and you buy it,
Right.
clock starts.
Right.
I would want to double check that, when it gets resold, what happens. But yeah, I think you get it though. Yeah. And you see, if it's only held for 3 years, 50% is excluded, which means some tax is being paid if it's being held for just 3 years. So there might be some short-term, with these changes happening, there might be some short-term where people don't want to hold something for 5 years and they do sell it right away, so there might be some revenue resulting from this change. If that makes sense, just because of basically the changes in human behavior, and it's hard to say what that's going to be.
Representative Odie?
Thank you. I just wonder if, when you were researching this, you read any articles that explained what the thinking was behind even making it having to hold it for 5 years.
I think this exists to encourage investors to invest in smaller businesses. Holding it for an amount of time helps the business.
Predictability. So do you think that did you read anything or see anything or talk to our state economist that would tell you that this would be beneficial for Vermont businesses who need investment money?
I don't know what Vermont businesses exist that issue this stock. I don't know anything about that. Thinking about it, the fact that this is being expanded and that the tax benefit's even greater than before, maybe this will cause there to be more Vermont businesses doing this. I don't know though. Yeah.
We will spend time digging into that.
So as I mentioned before, one of the things that's changed is the aggregate asset ceiling to qualify as a qualified small business is being increased to 75 million in assets.
Do you know what it was?
We'll wait 10 seconds. I'm not finding it immediately, and I don't want to hold you up, so I'll just send it to you later.
Okay.
If I were to guess, I'd say 50 million, but
My guess.
probably wrong. Okay, so that's the business tax stuff. We've got about 9 more corporate income tax changes that do flow through. And these are the more significant ones that we as staff have identified.
Can I ask just a really
Yeah.
quick question before you move on? Is there anything in the language around that limits it to startups or early stage businesses? Like, who qualifies for this? Is it anyone who's?
My understanding is it does tend to be startups.
I mean, it seems like that's who would benefit.
Yes,
But
I
I'm
think
wondering
that's-
how it affects the incentive versus setting up multiple related businesses.
From what I've read in the federal law, I think that it's set up in a way where it can't be gamed so that like a larger business can't just, through some tricks, set up one of these. But I don't think there's any limitation on how long the business could have existed before, though, either. But I think that it is oriented towards startups. Another thing that I'll note here is it's possible to issue qualified small business stock and use it to compensate your employees which startups do. So this is used by businesses in different ways. It's not just about investors. It can be used to, if you're short on money in the short term, pay people with stock.
Interesting.
But do they have the same benefits, the tax sheltering if you're giving?
If they hold on to it, yeah.
Okay.
Of course, there's no guarantee that the stock ever becomes worth anything either, by the way. I mean, just,
Yeah.
Yeah.
I'm trying to be quick, Madam
Yep.
Chair, but I have two things. I think, my hunch, somebody over here was asking a question about what this means for Vermont. My hunch is that there are a lot of businesses who would qualify, and more who will come into existence that want to take advantage of this. Small manufacturing firms and product producers, that's one thing. And my other thing is really a question. Is 75 million in assets? What does that mean? Does that mean the value of the company or the product they have sitting on shelves, or what are the assets?
everything, the buildings, personal property, everything.
How does the state have a way of knowing that? Because we don't do an assessment of businesses anymore, do we?
It would be something that the business determines.
Oh. Ah. All right.
I mean, yeah. And I'm sure that there is some checking by the IRS at the federal level to make sure that businesses claiming to be qualified small businesses are indeed that, but I don't know the extent to which they investigate that.
Thank you.
Okay, so corporate income tax flow-throughs, won't read the list, but we'll be handling these one by one. There's more. I've loaded some of the expected more significant impacts up front here. So the first one we're looking at is the domestic research and experimental procedures deduction at the federal level. The change here is, we mentioned before about the timing of things and how the qualified small business stock could have an impact farther in the long term. This particular change is all about the short term. So there's this federal deduction for domestic research and experimental expenses. Under current law, those expenses have to be taken as a deduction. They have to be taken over 5 years. And this was a change from Tax Cuts and Jobs Act, I believe. If there's one theme with all these changes, it is that some of this stuff is rolling back some of the strictness that came out of the Tax Cuts and Jobs Act. And this is an example where they're loosening it back up. They're not requiring these expenses to be capitalized and amortized over 5 years. They're going to start allowing them to be deducted as they're incurred, which means that people are going to get a bigger deduction sooner using this deduction. And there's an element of this that is retroactive for what they consider small taxpayers with up to 31 million in gross receipts, which lets them retroactively take these expenses going back to 2022, going back to the time in which they started having to take them over 5 years. So not only could you start seeing in the short term businesses fully expensing instead of spreading over 5 years these things, but also some of them going back and amending their returns from previous years to say, we're not taking this over 5 years, we're taking it now. So this is an immediate impact on corporate returns.
Kirby, just real quick. On some of the personal income taxes, you provided windows for when those expire. Should we assume that if you haven't written that down here, they are permanent?
Yeah, I think you should. I've tried to, it might not be perfect, but I've tried to mark it when, some of the reason, part of the reason some of those personal income tax changes sunset, by the way, is because in the reconciliation process at the federal level, if you're not, for that process, if you're not paying for tax expenditures as you go, then they have to be temporary. And that's why so many of those are temporary. And that's rules about like using the budget process to deficit spend. And there's like, federal rules around that. Okay. So moving on to the next corporate tax change is there's the amended limitation on business interest deduction. At the federal level, there's a corporate income tax deduction for interest paid on loans used for business purposes. The change here is basically you can take a deduction for the interest you paid on your indebtedness as a corporation. So you owe debt, you pay interest on it, you can take that interest as a deduction. But there's limits on how much you can deduct. The change here was changing how that limit is calculated. This is another example of things being loosened up after the Tax Cuts and Jobs Act. The Tax Cuts and Jobs Act changed this so that this calculation, the limit, was stricter, allowing less to be deducted. The change here is loosening that back up and allowing a larger limit on what can be deducted. And I think that's probably good for now. I could get into, yeah. Okay, so I'm going to move on to the next one. Exceptions from limitations on business meals deduction. Tax Cuts and Jobs Act, once again, tightened up this business entertainment expenses deduction that was allowed previously. If you think about, I don't know, Mad Men and like the lunches they would have, and then they would just take it off their taxes. So this tightened up that kind of thing as far as expenses relating to goods or services for employees. But the HR 1 here is going back and creating more exceptions to what was tightened up before. Some of those new exceptions are meals provided to crews on commercial vessels and oil platforms, and meals provided on certain fishing vessels and facilities. So things that may not necessarily happen in Vermont a lot, but it does flow through. The next thing that flows through is the increased limitation on expensing of depreciable business assets. There are certain smaller corporations that can expense qualifying depreciable business assets. Expense means take the full deduction for what they paid for the thing now instead of depreciating it. Which would mean that they take that deduction over years of time. So the maximum amount they can, under current law, the maximum amount that could be expensed using this would be $1 million. That's being changed to $2.5 million. These are when you bought a qualifying depreciable business asset in that tax year, you can expense it right away. I think I've already said the stuff from this slide. Similar but different thing here. At the federal level, they allow additional first-year depreciation deduction equal to 100% of the adjusted basis of qualified production property. So this is specific to certain situations, like this particular deduction is limited to agricultural and chemical production, so it's limited in a way. But taxpayers that that buy qualified production property can expense it 100% in the year that. So again, no depreciation. It's just expensed right away in these narrow situations. But it is something that flows through to Vermont.
So I just want to make sure I'm understanding.
Yeah.
Instead of having a depreciation schedule, you basically assume all the depreciation in the first year?
Yeah, I think this
That's
one's
wild to me.
based off of,
Yeah.
so this is, yeah, 100% of the adjusted basis. So in the world of capital gains, your basis is generally what you paid for the thing, and then it's adjusted with some additions and subtractions. But yeah, bonus depreciation.
Yeah.
Is this, it says production, is this mining or oil well?
It's non-residential property used in manufacturing, production, or refining of tangible personal property, but it's also limited to properties that are being used for the first time for qualified production purpose, which is, there's a definition for that. And it's limited mostly to agricultural and chemical production. So
Oil and chemical?
So to encourage companies that are in the agriculture or chemical areas to invest in manufacturing and production facilities.
And is this the section that applies to all businesses or just to corporations?
This is corporate income tax stuff here.
Okay, so I want to just sort of remind folks that corporate income tax isn't paid. Can you explain that part about who pays corporate income tax in Vermont? Because I think people assume it's Vermont businesses.
Oh,
Just like
I know what you mean.
Thank you.
For one thing, it's like the business has to be a C corporation or in some cases an S corporation, which, so that's going to eliminate a lot of what you might think of as a company or a business. Like if it's an LLC or a partnership, they're most likely not going to be subject to this at all. Well, those are passed through and they pay on the personal income tax. So we're just talking about C corporations for the most part, and the way that C corporations pay corporate income tax to Vermont is through allocating and apportioning all of their income from everywhere, and how much they use Vermont as a market depends on how much they're paying to Vermont. So when you're talking about a national corporation, it is a very small fraction of all of their income is what gets reported and paid to Vermont as corporate income tax, because Vermont is not a large market.
Representative Bodie.
So when I read agricultural and chemical production, I'm wondering if you read anywhere that that includes making more PFAS and more pesticides.
No, but maybe based off of those are chemicals, right? I don't know. Yeah.
Thanks.
Okay, so just for some context here, usually this property is depreciated over 39 years. This is allowing it to be depreciated 1. And it sunsets in 2028. So this is as Representative Wozniak was asking earlier about. So I flagged here this one sunsets in 2028.
On the depreciation, the recapture in full of the property is sold. Is that like over any period of time or ever?
I don't think it's not ever, but it's a long time.
Okay.
I can double check
So
the
you got to
years.
hold on to it for a period of time.
Yeah, I mean, it might be for the entire time that it was supposed to have been depreciated, so it might be the 39 years. I can double check that for you,
Okay.
but it is. I do recall it's a long time.
Yeah, that'd be
Yeah.
quite a,
That'd be something.
that'd be, okay.
Because these things are meant to incentivize in long-term investment.
Yeah.
Okay, so foreign derived income, I'm going to simplify this a lot because this is an area where there's a lot of jargon and we could get lost real fast. There's 2 major changes to how at the federal level they're taxing foreign derived income. This all comes from the Tax Cuts and Jobs Act, which created new ways to tax foreign income in the year in which it's earned, which was not something that was done before that. So the 2 changes from H.R. 1 are that there's there was a deduction of 10% of the tax basis of qualified tangible assets held by the taxpayer in other countries. It's called QBAI. HR 1 gets rid of that 10% deduction. That does flow through to Vermont. What it means is this foreign derived income is being deducted less than it was before, which means more revenue on their returns. And like I said, that does flow through to Vermont. So the part of this that's revenue up flows through to Vermont. At the same time, HR 1 increased the amount of credit that can be claimed for foreign taxes imposed on what's called controlled foreign corporations. That credit, though, does not flow through to Vermont. That's a federal credit, not a Vermont credit, does not flow through. So the part of this that would increase revenue potentially for Vermont does flow through. The part that would then reduce it does not flow through. And yeah, that's the short version of there were very many changes here, changing calculations and things that we can go into detail with later if you want. So moving to the next, there was a new rule created by HR 1 that if a foreign corporation is a controlled foreign corporation at any time during a taxable year, each U.S. shareholder that owns stock in the corporation must include in gross income their pro rata share of the corporation's passive income for the CFC's tax year. Basically, this just results in taxpayers who own stock in controlled foreign corporations, they're going to have to report more of that gross income from the stocks than they used to. So more taxes paid. And then we've got the renewal and expansion of opportunity zones. And this one is a pretty big change and potentially significant for Vermont, I'm not sure. So the Tax Cuts and Jobs Act created these opportunity zones. It's another way to encourage, kind of like the qualified small business stock thing we talked about, a way to encourage investment in places where, at the federal policy level, they wanted to encourage investment. So there's these opportunity zones that were created in every state, and they were supposed to expire in 2026. So Vermont has one of these, or at least one. This change makes it so that those opportunity zone designations will be on a 10-year rolling basis. In other words, they'll be changing and moving around. But they also were made permanent because it was supposed to stop in 2026. The way that this whole thing works is kind of like the thing we talked about before. This is for investors to get a tax benefit. An investor can invest in a qualified opportunity fund to support, in this case, it's about supporting real estate development in areas that are designated as opportunity zones. The policy idea is to try to designate places that are like low growth areas and to try to get investment into developing in those low growth areas. My understanding is at the national level, that's not always been the case. There's been opportunity zones that were kind of put in places that were already growing a little bit, which would make that an even more enticing investment. And I bring that up because we're going to get to it, but this does tighten up some of the definitions so that that changes. So a taxpayer can elect to defer any gain they get from investments as long as they hold them. So if you invest in one of these opportunity funds, you can defer tax as long as you're holding the gain.
Can I ask a hypothetical question? So if there's an opportunity zone in Oklahoma and folks in Oklahoma who need development there get the development as a result of the opportunity zone, and a corporation in, say, Arkansas, and investors in Arkansas are sort of putting in on that, but that corporation in, say, Arkansas, I really didn't have a hypothetical corporation when I started this, but it's really turning into one, sells into Vermont. Are we going to have a reduced revenue into Vermont are basically Vermonters going to be paying for the opportunities in the opportunity zone in Arkansas, even though our opportunity zone in Vermont might not see any benefits at all
The single sales factor.
because of the single sales factor.
Yeah, I'm scared to try to answer that.
Okay, then
but that is something we
we'll
should
talk about it
look
another
at.
day.
Yeah. But I think you're definitely hitting on the fact that these things can get very complicated, and this does flow through to Vermont, as in the gains that are deferred here. You know, in most cases, this would be a Vermont investor
But they don't have to be
would be
investing
able to,
in Vermont.
they would, no. And they could defer their gains, and possibly, as the slide here says, the bottom, it's possible to completely exclude the gain if the investment's held for at least 10 years. So this would be income that becomes excluded and not taxed by Vermont. But it would be for taxpayers that would owe money potentially to Vermont. So, you know, an Arkansas investor investing in Oklahoma maybe not affect us, but when they start to become subject to Vermont tax.
That would affect.
And in your example, they're using Vermont as a market.
Yeah.
So they're able to, yeah.
Okay,
So,
thanks. We can go deeper in it some other
yeah.
time with diagrams.
But yeah,
and
it
such.
sounds like, I think, yeah, that there's going to be an indirect Vermont
Okay,
impact.
thank you.
Yeah.
Representative Meslin.
Yes, thank you. A minute ago, you said there are things where you can defer the gains as long as you're holding the asset. Is that similar to carried interest? Is that the same principle? Is it the same thing, or does it just appear to be the same? There's a discussion over the last couple of years about carried interest and whether or not it was taxed or not. Do you remember that? It went on, it was quite a big deal in some circles for a while.
I don't think I was part of that, but I don't know if have we covered it? There is the business interest deduction. I think we covered it. There is a deduction for interest paid, but something that's not big.
I'll try to be more articulate the next time I ask the question.
Yeah.
I'm realizing we should probably pick up our pace slightly.
Okay, so expansion of opportunity zones. There's some tightening of some of the requirements, but at the same time, some of the incentives have been increased. So this is going to be more in the bucket of things that could have impacts on more of the long term. In the short term, I don't think there's not going to be a lot of Vermont impact, but as these things become established, there could be a longer term impact.
Do you have a question, Representative Bodie?
No, I just
Okay.
observed something I didn't want.
Okay.
Another thing to note that the HR 1 did here was it created qualified rural opportunity funds, which is that has enhanced tax benefits, and that could be something that ends up, Vermont could end up being one of those, and that could end up impacting Vermont as well. The charitable deduction for corporations, I'll go through this quickly. This potentially allows less of a charitable deduction at the federal level, which would impact, which would flow through to Vermont. It's creating a floor for a corporation to take a charitable deduction. Currently, corporations can make deductible contributions up to 10% of taxable income. This change creates a floor of you can't take any deduction if you don't make contributions equal to at least 1% of your taxable income. So now smaller donations can't be deducted. It has to be equal to at least 1% of the taxable income of the corporation. And then there's going to be the ceiling of 10% of taxable income. Thinking about this, I think this is going to be more of a changing taxpayer behavior thing than any kind of revenue thing in the long term, revenue impact in the long term. I think it might mean for corporations that don't make large contributions that maybe they'll start doing it every other year so that they can surpass the floor on the years in which they do contribute. but, speculation.
Just to clarify on that, Kirby, is that aggregate deductions or individual, or donations rather, for the charitable deduction? So like.
Aggregate.
Okay, great.
Okay, so a couple things on decoupling. Chair Kornheiser started this off by talking about recent changes. I have a slide here. You'll see since 2002, Vermont has moved more and more away from, when it comes to personal income tax, it's moved away from being based purely off of the federal return, and we're at a point now where we start with federal AGI. We do not start with federal taxable income, and in recent sessions, there have been even more changes to move away from that. There has not been as much work when it comes to the Vermont corporate income tax to decouple. One thing I just want to note for all of you, I'm not saying this to dissuade or persuade or to make you think any differently, but as far as decoupling goes, each of these changes we talked about could have administrative challenges. And it's going to vary depending on what that change is. So I'm not saying it to say don't do certain changes, but just know that if there's certain ones we want to tackle, I'll work with the Department of Taxes and JFO, and we'll try to figure it out. But some of them are harder than others.
And the tax department's going to come in to talk to us about it next week or the week after.
Great. And just some examples. The child dependent care credit, that would be easy. Deduction for domestic or deduction for domestic production, relatively easy. Some of these other things, opportunity zones, things like that, would be harder, but that's, again, just making you aware, not trying to affect your thinking. And with that, I can pass it on to Pat.
Let's take a 3-minute stretch break. Part 2, here, joint hearing, Ways and Means, Senate Finance, day 1, legislative session, beginning with a bang. Part 2, thank you, Pat Titterton, for joining us.
So, Patrick Titterton, Joint Fiscal Office. I do commend all of you for really jumping in like this.
I don't know if anyone had a choice.
So, you're going to hear me say a lot of the same things that you just heard Kirby said. I'm going to try and say them differently. So if you understood something Kirby said and don't understand me, and vice versa, hopefully we can triangulate it. I likewise, I'm going to talk about a couple of things in personal income tax that were sort of very much in the news, but don't necessarily affect Vermont. We're going to talk about looking at the tax forms, how we actually figure out whether something's above the line or below the line. And then for the business tax side of things, there's so many things in there that I'm also going to focus on the things that are actually flowing through. We can, of course, talk about all that at a later date. But I guess jumping into it for personal income taxes, Reconciliation Act included a lot of different provisions. Again, I'm focusing on ones that were sort of more popular. I might reference a couple of more esoteric parts of it that are not in the presentation, but some ones that you just heard about is the deduction for tipped income, the deduction for overtime pay, the automobile loan interest payments, the enhanced deduction for filers ages 65 plus, and then that child dependent care credit phase down or expansion. And again, not all of these flow through. Some are above, some are below the line. But just to quickly summarize again, because it was over an hour ago at this point, for the tipped, the deduction for qualified tipped income, filers can deduct up to $25,000 of that if they have an AGI of 150 or lower. That's for single filers, or $300,000 or lower if they're married for joint filers. And then again, this is sort of phased out beyond that point. Kirby mentioned this is temporary for tax years 25 through 28. The second thing was that overtime income deduction. So again, they can deduct $12,500 of that if they are below an AGI of 150,000 if they're an individual filer. If they're a joint filer, they can deduct up to 25,500 if their AGI is below 300,000. And again, temporary through 2028. There you go. The deduction for automobile interest, it's for interest paid on qualified passenger vehicles, and it's limited to vehicles with final assembly in the United States. So it's not just any vehicle, it's specifically those sort of final assembly in the US. Yeah, so you can deduct up to $10,000 of that for if you are an individual with $100,000 or less of AGI. If you're a joint filer, less than $200,000. And the deduction is for the interest paid that is accrued within that year. It's not sort of prospective looking. It's just for what's been paid in that year. This
That's
is also,
for a loan, right?
Yep, so it's the interest paid on your auto loan.
Got it.
And then, yeah, there's that enhanced deduction for senior citizens. And that is phased out for filers with AGI above 75,000 if they're single filer, and 150,000 if they're joint filers. Again, temporary. So you heard all that. And one thing that I found through this whole process that actually was really helpful in understanding all of this, and is probably really boring sounding, is going and looking at the actual tax forms and sort of using that to use sort of like develop a flow chart for determining this kind of thing. So what we have here is the federal form 1040, which includes the calculation of your income that ultimately adds up to adjusted gross income. Now, we always say that adjusted gross income is the starting point for Vermont-based personal income taxes. And so when you look at this form, in this red box towards the bottom here that I have, that line 11A is our starting point when we're just talking about Vermont income taxes. So lines 1 through 10, those are purely sort of the feds have full control over what the definitions are within that, what is and what is not included, whether you're including all of that type of income. I mean, the biggest thing on here you'll see is that W-2 box. That's going to include your salary, wages, tips. I think it includes Social Security income as well. So that's sort of the primary box that a lot of Vermonters and Americans are going to be filling out for the most part. There are certainly other things that go into income. You see further down, there's IRA distributions, there's pensions and annuities, capital gains. So as long as the feds aren't touching any of what defines those types of income and their inclusion in this part of the form, it doesn't matter to us, right? So, I just mentioned, well, you report your tip income up here in line 1A, right? The deduction doesn't actually show up until we get below that line 11A, and it's in this other part of the form, line 13B. So that line 13B that is the Schedule 1A, that's where you see, it's a new part of the form, that's where you see the tipped income, overtime pay, car loan interest, and the enhanced deduction for seniors. That form only includes those 4 things, and that's below the line, so none of those are flowing through. So for the concept of flow through and above the line, below the line, does that kind of help illustrate that a little bit for folks?
Yes, that's very helpful.
Good.
It's literally a line.
It's literally a line, quite literally. Yeah, it didn't take a lot of imagination when they were coming up with it. Okay. So, this thing. So a lot of you have seen this before. We take that line 11, was 11A? 11A, which was the federal adjusted gross income. You see here that is our starting point for Vermont's personal income taxes. Now, we do add back some things like bonus depreciation and interest paid, or interest earned from non-Vermont state and local bonds. but we have our own standard deductions, our own personal exemptions, and some other subtractions we make from that to get to Vermont taxable income. And I'm showing you all this again. You'll see where I'm going here, or sorry, the next slide. That Vermont taxable income is then what flows through our brackets, those marginal brackets, which I'm sure you're all familiar with. And then we get to credits. Now, credits are something that, let me back up. On the federal return, credits show up further down on the form than I even showed you. So that any changes that the feds are making to their credits, that's all stuff that's below the line. However, there are a few different credits that Vermont has where we are coupled to the federal calculations of them. So one example is the Child Dependent Care Credit. And I call that out because Vermont has a state level Child Dependent Care Credit that is equal to 72% of what you can receive from the Fed. So while we have our own separate credit and their credit's below the line because we have in statute calling out their calculation of this credit, it shows up here, and that's why that particular, in that particular instance, that can flow through even though it's below the line, right? Another example for this is the earned income tax credit. That's another one where we just take an applicable percentage of your federal credit amount. You can receive it on your Vermont tax return as its own state-specific credit against your state tax liability. So I don't have as many words about how the phase down changed because I do have a chart right after this, but the upshot is for the Child Dependent Care Credit, the maximum amount you can, the maximum credit amounts didn't change from pre-HR 1 to now, but the percentage of dependent care expenses that you have did increase. It went from 35% to 50%, and they even have an extra plateau, which you'll see in a second. And again, just said maybe a slightly different way, all this means is that if you pay $1,000 for childcare, you can get $500 back as a refundable credit in the state of Vermont, based on that. Again, it's refundable. We talked about the federal credits being calculated below the line, but we're linked in that way. I guess the other thing I have in this presentation that Kirby doesn't is I have some numbers. We are estimating that this change starting in fiscal year 2027 is going to add an additional about $1 million to this tax expenditure in the state. So now this is on top of what we already have for tax expenditure. In the last tax expenditure report, which there was shorthand for that, we were projecting that in 2020, for fiscal year 26, that would come in around 4.8 million. So $1 million on top of that going forward. And so, yeah, we're expecting this revenue to start kind of decreasing starting in fiscal year 2027. So not immediately for fiscal year 26. Okay, this is the chart.
Oh, thanks.
So this green line here shows you what the reimbursement rate was under Tax Cut and Jobs Act. You can see it starts over here on the left at 35%. There is a phase down period up to $43,000. And then it just stays constant at 20% as far up the income spectrum as you go. And it was the same for both individual filers and joint filers. So the change that the feds made is they did two things. They split it so there's two schedules, one for individual, one for joint filers. And they sort of implemented two totally different phase downs. So both jump up to 50% reimbursement rate up to $15,000 of income. They both phase down to 35% reimbursement rate at that $43,000 AGI point. Then you can see in the orange there, which is the unmarried filers, there's a plateau up until I think it's about $75,000, where then again it starts to phase down to that 20%, which just stays at 20% no matter how much you're making. For the joint filers, at that same point where single plateaus, it just slowly comes down to the 20%. Are there any questions on the chart, or does that sort of help illustrate
I
that?
love the chart.
Okay.
But there's a maximum credit amount, correct?
Yes. I think it's around $3,000 per dependent. And then if you have 2 dependents, that amount doubles. But the expenses have to specifically be for each dependent. You can't just load them all into one dependent and the other. And there's a whole, dependent is defined a little bit differently for this particular credit than it is sort of traditionally. I think they call them qualifying individuals. Okay, so that is personal income taxes. Next, we have the area of my portfolio that a colleague of mine has claimed is Byzantine and esoteric, and that is corporate and business income taxes.
Did Chris say that?
I'm not naming names.
Kirby's denying.
Kirby wouldn't say it.
So again, I just want to reiterate that we're really going to be focusing on things that are flowing through, and I pulled another form that we can look at that's specific to corporate and pass-through entities, and where all of these changes that Kirby just walked through with you and I'm about to walk through with you live on the form. And so, yeah, we'll do a similar type of exercise. So this is IRS Form 1120. There is one for C Corps and there's one for insurance companies, S Corps, all different kinds of pass-through entities or different incorporation types. This particular one is for C Corps, but generally speaking, they're all structured almost identically, if with maybe some variations here and there. So this is the first part, the first half of the form, and what you're seeing here is how we get up to how we total all of the money coming into your corporation to get to what your total income is. And just to note, total income does not equal taxable income, which we'll see in why a lot of these changes are flowing through, because this is just the money coming in. It doesn't factor in the deductions, which ultimately get us to taxable income. So like with personal income, where line 11A is the starting point for Vermont personal income taxes, line 28 on this form 1120 is our starting point for corporate income taxes. This line is I've referred to it before when talking about corporate income taxes as total net income or something like that. And to the clarification point earlier that Kirby spoke to, this is pre-apportionment with that single sales factor.
So who pays corporate taxes in Vermont?
C Corps.
Okay.
Every C Corp that sells to the Vermont market will be filing a return and have to apportion some of their net income towards Vermont corporate income taxes.
So if I have a corporation here and we have our headquarters here and all of our employees here, but we don't sell anything here, do I pay corporate income taxes?
Well, so interestingly enough, there are quite a lot of corporate income tax filers who file zero basically income returns in Vermont. And what I mean by that is they just file in all 50 states, but if they don't have sales into Vermont, they aren't paying anything. So if you are a Vermont-based, headquartered, have a bunch of employees here, all that kind of stuff, but you only sell into New Hampshire and nowhere else, you're not going to pay anything in Vermont corporate income taxes. Of course, there's things like payroll tax, property tax, stuff like that, but no.
Thanks.
is the short answer.
I like the long answer too.
And by opposite, a company that's not headquartered here but has sales here, such as Comcast or something else.
Yeah.
This was the change we made like 4 or 5 years ago.
Whenever that was, yeah.
21.
Sure.
That was in response to the Tax Cut and Jobs Act, I believe, earlier.
After. Recently.
Yeah. Because it started out as a tampon tax bill. And then
Oh, that was so fun. I forgot about that.
Yeah.
Right.
Some of us are still going to get even for that.
Some of us are still happy about it.
Those are 22.
Back to you, Pat.
So in other words, this line 28 is our line. All of the things I'm going to talk to you about next are occurring in lines 12 through 27. So that's above our line 28 line. So I'm not going to read every single one of these because it's a long list, but these are all the things that Kirby just spoke with you about. And I'm going to try and give a slightly briefer summary of what they are and also sort of describe what we're thinking the fiscal impact to the state specifically, to the state's revenue picture, not what their federal picture is going to look like and how that's changing at all, just the state revenue picture. So the deduction for domestic research and development expenses. So to put it again, this changed how these expenses are deducted and calculated on a year-to-year basis for corporations. It's actually reverting back to a pre-Tax Cut and Jobs Act change, where previously you could fully deduct those expenses in the year that they're incurred. Tax Cut and Jobs said you have to amortize that over a 5-year period. We're just going back to the previous treatment where you can deduct it all right up front in the year that it's incurred. I guess I should caveat that by saying if the deduction's more than your tax liability, you can carry it forward. And so one thing also in this is that HR 1 made the R&D expenses that you can deduct retroactive to 2022. So presumably there's some expenses that companies have been amortizing over their 5-year period. They still have some left on that amortization period. So they will be able to sort of look back, anything that's not been deducted already, they can deduct now. So would that look backward? And what that does in 2 ways, with the look back and with the fact that any expenses incurred now going forward can be deducted right away, is that it's really going to sort of front load a lot of those costs. So this change in how the timing of when you can deduct these expenses is expected to reduce state revenues by approximately $2.3 million in fiscal year 26 and 27, and then sort of gradually wane going forward. Because in some ways, if you think about it, this is kind of more of a cost shift rather than an increase in cost. So over the super long run, it's kind of a net neutral change in some ways. But for the immediate future, it's certainly going to be a net negative we see in terms of the state revenue picture. So that was R&D. The amended limitation on business interest deduction. So HR expanded that limit to which corporations can deduct interest paid on loans for business purposes. The limit is limited by the sum of their business interest income, so the amount that they're actually earning on interest, or their floor plan financing, which I had to look up what this was. It seems very specific to like auto dealers, where they'll receive a lot of vehicles from a manufacturer sort of on credit. They're paying interest on that vehicle while it sits on the lot. Once they sell it, they pay off the principal and the interest and keep the rest. And then The third sort of limit that can come into play is 30% of their adjusted taxable income. So there's sort of 3 limits. What HR 1 expanded was the percent of business interest paid that can be deducted. That just went from 30 to 50%. So, and again, because Vermont is coupled, it's happening above that line 28 that we just saw. This change is estimated to reduce revenue, and we're estimating approximately $1 million annually starting in fiscal year 2026, and moving forward.
I have a question. So these revenue projection downgrades are based on the current businesses that are paying these taxes? It doesn't have anything to do with the projection of increased businesses or depreciated businesses throughout Vermont?
Sure. So I can take a step back and talk about what we're looking at with all of these. So over the course of the summer, Kirby, myself, a whole slew of people at the tax department have been working through things like what is flowing through. Well, how do we come about estimating this? So we've been working together on a lot of these questions. And for the estimates in this specifically, we're sort of utilizing both some in-house data that the tax department actually has, but for other areas, and this is particularly true in corporate finance in general, there's a real dearth of information available. So sort of the basis of what we were working with is, so there's the Joint Committee on Taxes, it's JCT, they kind of are, they're sort of like how the CBO does a lot of economic and policy projections, but they do a similar role for scoring tax policy. So they did that for this bill. And so they did have presumably some estimates in there, which I don't know the exact methodology they're using, but it was clear to us, particularly looking at, I think it was the R&D estimate, it was very clear to us that they were assuming some degree of growth. What that particularly was, we're not sure. But we did look around at a lot of methodologies that other states are using. And it seems like everyone's kind of in the same place with what they have available to look at to come to some of these estimates. And so again, I have some numbers here. It's corporate income tax. It's incredibly volatile. So it's really difficult to look at. And also, I think us in the tax department's going to want to go back and sort of revisit all of this when the new forecast comes, the consensus forecast comes out for the state.
Which is next Friday.
Right. But I guess all that is to say there's a lot of uncertainty, particularly because we're talking corporate income taxes here.
Thank you.
Okay.
I just want to take a minute to thank you and Kirby and the team at Tax. Like, you all started working on this when it was like the federal law had just passed and there wasn't even guidance attached to it yet. And I know you've been just like digging in really deep on a lot of incredibly confusing work. So thank you both for doing that.
We've been trying.
Yeah, and there's a really great comprehensive memo that this sort of covers everything in the PowerPoints, but in a slightly different way, and that's posted on our page for today.
Okay. So yeah, $1 million in sort of anticipated reduced revenue annually for corporate income from this particular one. Exceptions from limitation of business meals deductions. I have to be honest, I had to read over this section 100 times before I really understood what it was saying. But Kirby, I think, explained it pretty well earlier. Before, there's sort of a general deduction for business entertainment expenses. He used the lunch example, but so TCJA eliminated a lot of that sort of broad ability to deduct those expenses and made them much more sort of stringent. HR 1 maintains these restrictions, but they created a couple of new exceptions to things that can be deducted, certain expenses. That included when an employer offers food or beverage and the employee pays the same rate that the general public is able to pay for that product, or food or beverage. And then meals provided to crews on commercial vessels, on oil platforms, provided on certain fishing vessels and facilities. So again, you probably might think, well, we don't really have those industries, but again, remember, this is going to be corporations that are selling into the Vermont market. That said, through the analysis, I think we were looking at thousands of dollars, not tens of thousands, thousands of dollars in potential revenue impact. And so I always get asked, so how do you define de minimis? It's not really a strict rule, but I think it's appropriate in this case that we're talking about a fairly limited in scope sort of revenue exposure for the state.
Unless we find oil.
So the limitation on expensing for depreciable business assets. HR 1 increased the maximum amount that a taxpayer could expense for the cost of a qualifying depreciable business asset in lieu of recovering the cost through depreciation. Kirby described this well. It's really geared towards small businesses. It's saying that instead of amortizing it over the lifetime of the product, these are durable goods or buildings, you can instead take that depreciable value up front. It's pretty limited. It went from $1 million to $2.5 million. And again, it's really sort of going to be geared towards some of the smaller businesses. Again, we're coupled, so it's going to flow through. And we're estimating approximately $250,000 revenue or foregone revenue in fiscal year 2026, and then rising to approximately $600,000 in years going forward. The special depreciation allowance for qualified business assets. So this is the one that has to do with qualified production property. So with this change, you're able to now deduct 100% of its adjusted cost base. It's a 100% bonus depreciation that specifically can be used for qualified non-residential property, which, as Kirby mentioned, is for manufacturing, production, refining of tangible personal products. And again, it's largely limited to agricultural and chemical production. Just to sort of illustrate the change, typically this would be like a 39-year amortization schedule. This is saying you can take that up front. And importantly, if you're a corporation that has taken the full depreciable amount and you sell that property, that sort of gets clawed back. So in instances where a new corporation buys that building and then does the same thing, it sort of nets out. So that's why you might be kind of confused as to why, and it only applies to properties bought after January 19th, 2025 and until January 1st, 2029. So with the prospect of it netting out, but then being clawed back if you sell the property, or if it's a new construction, and new construction takes a little while, there's sort of going to be a little bit of a phase-in for when the revenue hit kind of comes about. So you can see in fiscal year 26, somewhat limited, maybe 250,000, but by fiscal year 27, we're thinking about 3.5 million. By fiscal year 28, about 5.2 million. And then we don't usually like to project much farther than that because of the uncertainty. But just wanted to give you sort of a little illustration of this is something that could certainly ramp up over time. But it is temporary. It's only between 2025 and 2029. So yeah. So foreign derived intangible income and global intangible low taxed income. All right, this is the foreign income that Kirby aptly described as. So we have like two and a half hours right now. We could do two and a half hours just on this. So this is 5 bullets and I put it about as simply as I can attempt to put it. HR would increase the base used to calculate foreign derived intangible income. So there's kind of 2 examples I remember from a year or 2 ago that I used to try and illustrate what the heck that means. So foreign derived intangible income is an instance, and this is sort of a narrative, it's not true in every single case, is an instance where you've got intellectual property held domestically, maybe a copyright on, I don't know, SpongeBob. You license a foreign entity to sell t-shirts with his image on it, and they pay you royalties or licensing fees. So it's kind of maybe helps you sort of understand a little bit of what that means. That's a really blunt explanation. So it increased the base used to calculate that, while at the same time increasing the percentage of this income that could be deducted. So it's effectively lowering the effective tax rate on it, but at the same time increasing the amount of money that lower effective tax rate is subject to. The net effect of that is a positive revenue swing for the state. So the other piece of the foreign income was the elimination of the 10% QBAI that Kirby mentioned earlier. And for GILTI, again, this is the narrative sort of explanation of it. You are a US company and you've got a foreign subsidiary and you park your intellectual property in that foreign subsidiary. And then you pay that foreign subsidiary royalties or licensing. I will tell you now, that is not how the formula for this particular tax type actually works. It's much more complicated than that. It does not just apply to intellectual property. But that is sort of, when you read about it, a lot of the narrative explanation for how people think about it. So yeah, by removing this 10% deduction from that tax base, again, you're increasing the amount of income that you have to report as income for your tax return. They did rename them. They're on the screen. It's a mouthful. But Vermont is coupled to the federal treatment of these types of income. So again, it's something that's going to flow right through the state. But this time we're talking about an increase in revenue. We've spent a long time on this estimate, a lot of back and forth. It's something we're probably going to want to revisit. But estimating about $2.5 million in increased revenue in fiscal year 26, raising to potentially about 3.2 in future years.
Pat, does the revenue estimate at the federal level go up, or is it just a weird quirk of Vermont's tax law that it's going up in Vermont?
So I don't know exactly if it's going up or down, but what I can say is that one thing Vermont does not offer corporations reporting this type of income is a credit on taxes paid to a foreign country. So that is something that is available to corporations. And if I remember correctly, that credit amount was increased. Kirby's nodding. So on one hand, you see the increase in revenue that we're getting because we don't allow the credits. On the federal side, they alleviated some of that increase in revenue. And really, I think part of the basis for doing some of that was this actually, it's still complicated, but this actually does simplify some of the calculation of these income types. So it could be a little more efficient moving forward. But yeah, we don't offer those credits for the foreign taxes. All right, so the changes to pro rata share rules. This changes the treatment of controlled foreign corporations, or CFCs. What that is, a CFC is a foreign corporation, is a CFC if at least 50% of the voting power or value of the stock are held by U.S. shareholders. Each U.S. shareholder must include in their gross income that they report their pro rata share of the CFC's passive income in that tax year. So taxpayers who hold CFCs will have to report more gross income than they would have previously, and this does flow through to the state. So we're not expecting a change in this for fiscal year '26, but it is estimated to increase revenue by a modest amount, maybe 100,000 in fiscal year '27, 240,000 in fiscal year '28, and growing gradually thereafter. I got those dates wrong. 100,000 in '26, 240,000 in '27. Sorry about that.
It's okay.
Okay, the opportunity zones. So this makes permanent creation of these zones done in Tax Cut and Jobs Act. So this encourages investment in these in qualified opportunity funds, which support real estate development in those opportunity zones. And again, if you elect to defer the gains from these investments, as long as you can defer these gains for as long as you hold them. And the longer you hold them, the more they appreciate, the greater the tax benefit is on that. And currently Vermont has 25 opportunity zones. They span over a census tract typically. So somewhat limited in terms of physical footprint. You're not talking entire towns usually, unless it's a very small town. So that's sort of what was maintained or made permanent, and usually from a sort of accounting standpoint, making something permanent that was temporary up until that point usually we don't usually consider that a change in revenue, because you're just maintaining current law even though it had a sunset on it. But with the creation of the rural opportunity funds, those could start to flow through to the state and decrease revenue over time. I forget who has to, well, yeah, I'll save that comment. So yeah, the implementation date on these is is out a couple years, so no immediate impact of these, but forward-looking, it's certainly something that'll flow through. And the hypothetical earlier about Oklahoma and Arkansas, I believe because of the single sales factor, those corporations would be able to defer those gains, and that would affect Vermont. So that is something that would flow through, and kind of comes back to that discussion about the single sales factor.
Can I ask just a couple questions? Did you look at the number of investments made in the opportunity zones since the Tax Cut and Job Act was put in place? In Vermont, and the 22, I think you said, zones that we have in Vermont. Anybody take a look at that?
I haven't looked at those particular funds.
Okay. And
I know there's 25.
And the deferral of any revenue would be deferred, is only upon the sale of that property and the gain that will result from it. Am I getting that right?
I believe that's my understanding as well.
Okay, so there's no other tax incentive beyond just the deferral of a gain from a property sale now?
That's my understanding.
Okay, great. Thank you.
There's, of course, so much nuance to all this.
Yeah.
Kirby was nodding.
Okay, thanks, Kirby.
Yeah.
I understand we're going to be going through this all again.
Yep.
And when you do, can you help us understand the growth assumptions under the categories that you've just gone through, where the assumptions of revenue changes are based on assumptions about growth? And I'm also just curious about opportunity zones, because in other states, the gains in opportunity zones are often offset by loss of economic activity in surrounding zones, and I just wonder if that's true in Vermont.
Yeah, I could try. So part of the problem with the JCT estimates that we're sort of using is we could tell that they had some kind of assumption that they were using through inference, but there wasn't a sort of catalog that we found of the specific methodology used. So unfortunately, it's kind of difficult to parse out, but it's certainly something we in particular struggled with the research and development expense deduction. But we can look at it again and see if maybe there's something new. Okay, so the charitable deductions for corporations. Previously, this is maybe the simplest one, honestly. Previously, corporations could deduct their charitable contributions up to 10% of their taxable income. HR 1 just says, well, actually, you can only deduct the amount of charitable contributions between 1 and 10%. So that bottom 1%, they're really just subtracting 1% and creating a floor that you need to hit. And above that floor, up to 10%, that amount can be deducted for charitable contributions. Not expected to change state revenues in 2026, but it is estimated to increase revenue, right? Because you're reducing the deduction amount by creating that floor and not raising the ceiling by approximately $140,000 in fiscal year 27, and sort of increase gradually over time. Yeah. So we're getting close. And then I have a summary table to show you everything put together. So these are the business taxes, and this is the accounting changes for certain residential construction. This is previously income from certain home construction contracts was reported at the end of the contract rather than based on the sort of completion percentage of the project. It was limited to construction projects with 4 or fewer units or contracts completed within 2 years by taxpayers with $31 million or less in gross receipts. And so HR 1 expands this treatment of the income reporting, so being able to, when you actually claim it, expands that treatment to all construction contracts completed within 2 years. So it's taking out the $31 million or less in gross receipts caveat to that. Yeah, and so what this does, it amends the timing of when this income needs to be reported, not exactly changing the income that needs to be reported, but more so the timing. And it's not expected to change state revenue in 26. And looking forward, we're not expecting it to exceed about $100,000 in future years.
So, Madam Chair, I have a question. I guess I'm a little confused. So does this apply only to those contractors that are contracted with the owner of the property? So if they are not the owner of the property, because in terms of an owner might not recognize anything until the property is completed and sold in terms of revenue.
So I believe that this is actually on the flip side. This would be when the building company has to report that income.
Okay.
So it's not the owner of the property who has this development, it's the builder who gets paid sort of, when you build a house, you have to pay in installments for the work that's been done thus far. This is saying you can just wait till the end to claim all that income.
Yeah.
Yeah.
Okay, so if right now, if I'm ABC Home Building Company and I'm working for you, I don't have to, right now, I don't have to declare my income until the project is done. That just changes it to percentage completion. Fascinating.
What if the project's never done?
No income. Huh. I'm not sure about that.
We don't have to answer that.
Clarification, though, from what was just said. The change is percentage of
Will you
completion.
come, I'm sorry.
It's okay.
Thank you.
Kirby Keaton, Legislative Council. Currently, for a lot of these contracts, the accounting works so that the builder, as Pat was saying, is reporting the income as they complete the project and have to pay. This changes it so that, yes, they just report the income at the end of the project and they pay then. I heard something that was slightly different than that, so I just wanted to make sure that was clear.
That's what I heard. Yeah. Representative Bodie.
Thank you. If you go back to the slide before it, what I don't understand is within 2 years by taxpayers with 31 million or less in gross receipts. Who's the one with the 31 million?
That's the builder. So these are all eligibility requirements on the constructor of the project. So the person who's completing the work for the project.
But where do the gross receipts come from?
They could have multiple projects. They could be building a development over here. They could be all over the place. So What this is doing is lifting some of the revenue restrictions on whether you can qualify for this, and also some of the scope of the projects.
So those two limits are gone.
Oh, expands.
Yeah.
Representative Lazar?
I'm good, thank you.
I just want to make sure I'm reading your slide right. Under previous law, it's for fewer units and that 31 million, and under the new law, they don't have those restrictions?
The new law is expanding so that so it's really just if you're completed within 2 years.
No matter what size your project is?
Right.
Great, okay, thanks.
Okay.
Thank you.
Residential.
Right.
So when it says 4 units, is that for buildings or for apartments?
That's past law, though.
That's tax law. Okay.
Past law. Past.
Yes. All
But
right.
I would still understand that to mean dwelling units.
Okay,
So for like a quadplex, for
okay.
example. Okay, so the expanded exclusion on gains from qualified small business stock. So again, this is only for this type of stock issued after July 5th of 2025 with aggregate gross assets. And I don't think this is something that Vermont State would need to be tracking, whether those assets are valued at that point. That's, with any stock issuance, there's typically going to be some form of federal oversight with actually sort of the valuation. Because you can't just issue a stock and say, trust us, in most cases.
Federal oversight, is that still a thing?
Federal FOMC? No, that's Federal Open Market Committee.
Depends on the day.
I need to look into like which particular federal agency would be regulating something like that, but
You're saying we show on the
Exchange.
no, it's just the ensuring that the company issuing the stock is, I guess, honestly valuing their assets.
Sounds like everything's in order. Somebody will have to order a because so many t-shirts sitting on the shelf, that's an asset.
Inventory, yeah.
So let's go to the next.
Okay, we're good on this one? Yeah, delete, summary. Yeah, no, we're there. So this is kind of everything we've just talked about put into one table, so it's easier to conceptualize all the numbers I was throwing around. In particular with, the international tax provisions and the upward effect that they have, in that first year, it's appearing to be somewhat limited in scope in terms of revenue downgrade. However, Colorado had a really good quote in their forecast. There's a lot of, I think the term was bi-directional actions happening in this bill. And because this is such a volatile tax type, it's not hard to over or estimate any individual one of these pieces. So again, I think we're going to want, I think I speak to the tax department as well, we're going to want to look at these again once the new revenue forecast is out to see, again, how we feel about it. But this is where we're at right now.
This is just corporate income tax. This is, we're not making any conjecture about here about what might happen to payroll tax or personal income taxes or property taxes that might result from the economic development that this is supposed to create.
The only small caveat to everything you said, which is all correct, I do have a line on here for the child independent care credit extension.
Thank you.
Any other questions? Thank you so much. Thank you, everyone, for a lot of information in an afternoon. And I thank you for coming back again tomorrow after today. We are done for the day.